So, autumn budget, December 2025. So, a bit about myself, Carrie Stokes. I'm the director and founder of Spotlight Accounting. As with all our webinars and seminars, just the usual disclosure that it's for educational purposes and it's not specific tax advice. If there is any specific areas you want to discuss, please get in touch. So just by way of a background, I am going to start with the Labour Manifesto pledge, which was not to increase basic rate, higher rate or additional rates of tax, and not to increase national insurance contributions, not to increase VAT except for with private schools, and to cap the main rate of corporation tax at 25%. They were not going to increase the taxes on working people. So in effect, they've put themselves in check because if thinking of a game of chess, because they can't do a lot with the key revenue streams into the Treasury. They haven't actually ever really defined what they mean by working people. I'm going to go by each area and run through the main changes with some tools and planning. For self-employed people, there's no significant changes to tax and national insurance. Making Tax Digital is coming in from April 2026 for the self-employed with income over £50,000 and then £30,000 from April 2027. Stealth tax does impact them, and I'm going to discuss that later on. So what is Making Tax Digital? It relates to income tax. It's a requirement for taxpayers to keep digital records, to submit quarterly returns to HMRC using compatible software. From April 2026, it's income over £50,000. This also applies to landlords as well. And for landlords, it is the gross amount received, not the net amount after the agent's charges. And from April 2027, it is for sole traders income over £30,000. As I go through this presentation, there's going to be a common theme of where HMRC are going in the next 5 to 10 years. And again, I've mentioned it's before management charges are deducted. April will be here soon. And again, even those that fall under the regulation from April 2027, our advice is to plan early. Our recommendation is 0, or if you have a NatWest Bank account, you can have free agent for free. But again, get onto the software early and get used to it so that it's not a big panic when it comes to making your submissions. Employment tax. There are no changes to the rates of tax on national insurance, but the lower earnings limit has increased from 5,000 to 6,708 from the 5th of April 2026, which is a £256.20 saving on national insurance, employers' national insurance, so it's a business saving per employee. There's a 15% NIC on salary sacrifice arrangements on employers' pension contributions over £2,000. The draft legislation does not show any impact on directors' pension contributions because they're not part of a sacrifice arrangement. However, that isn't guaranteed. We're only at the draft stage of legislation at the moment. There's increase to the national minimum wage. The main rate will go up to £12.71 from the 5th of April 2026. So just putting the increase using a 37.5-hour week. Over 21-year-olds that are on minimum wage is going to cost an extra £975. 18 to 20-year-olds is an extra £1,657.50. And under 18s is an £877.50. But the actual increase in the gross wage isn't a reflection on the increase of the cost to the employer. So if you add on pensions and national insurance, the actual increase is £894.30 for over 21s, £1,699.65 for 18 to 20-year-olds, and £779.25 for under 18s. However, if you're a business to consumer customer, you're going to have to wrap in the cost of those wages into your pricing, and your pricing includes VAT. So, for example, an 18 to 20-year-old, the increase, including the VAT uplift, is £2,039.58. Employers are struggling as it is with the national insurance hike. They're only going to, most are going to reflect these increases in their pricing. So again, the cost of things will go up. And as an employer and as a business, we're saying, you need to review your pricing to make sure that you aren't out of pocket as a result of these expenses, because your costs are going up and your margins are being squeezed. Planning points, as I've just said, review costs and make sure these increases are reflected in your pricing. Automation, AI is a big thing at the moment, and there's lots of talk about it in the press and social media. What can you automate and where can efficiencies be gained? My gut feel is that people are going to keep head count where they are, and this isn't going to help with the employment statistics. Salary sacrifice, if you employ people and salary sacrifice is in place, make sure you review the wording on your contracts. Personal tax. Personal allowance is going to remain at 12,570 until 2030-31. Higher rate and additional rate thresholds are also going to remain frozen. Dividend income will have an additional 2% tax from April 2026. Property and savings will have an additional 2% tax from April 2027. That includes interest income. Cash ISA limit has been reduced to £12,000 for under 65s. Home working expenses, where people have claimed them on the tax return previously, they won't be allowed. You can only have home working expenses where they are claimed as a reimbursement. So how do you pay yourself as a sole director from April 26? Just using the current tax year, taking out 50,000. I've run two examples, 50,270 and £60,000. The reason I've used the £60,000 is, you'll see in a minute with stealth tax, thresholds have remained as they are for a number of years. While most directors take up to the 50,270, it's becoming increasingly difficult to maintain a basic lifestyle on that level of income. So at £50,000, personal tax this year is 3,255. Next year is 3,999. I've assumed that this is a sole director, so you can't get the employment allowance, which wipes out your national insurance. Employers' national insurance this year is 1,135.50. It drops to 879.30 next year. 25% corporation tax of 3,142.50. So your net tax is 1,248 against £1,735.80. £487 increase on the tax year, which is actually a rate of 39%. If we look at £60,000 income, net tax is £4,575.63 against £5,268.03. The increase is 15%, which is £692.40. So planning points for directors. Employment allowance. If you are on the payroll on your own, and if you have family members that do admin, these can go on the payroll for a small amount and you'll qualify for your employment allowance. That saves, you scroll back up, the £879.30. What are your outgoings? Again, looking at your cost of living, does the basic rate tax band cover it? We are getting to the point that directors will have to go into the higher rate tax threshold. Do you suffer it? trivial benefits, are you using them? So each director can have, it doesn't sound a lot, but 50 pounds up to 6 times a year. And when you're mitigating, I'll scroll up, an increase of £487, it does go a long way to sort of helping bridge that gap. And looking at your family tax position. So again, re-look at who's working in the business, your spouses, your partners, and if they have got available basic rate tax band. Stealth tax. There's a lot talked about it in the press, but this is just trying to put it into figures. The last time the personal allowance was given an inflationary increase was in 2021, 2022, where the main state pension was £179.60. Personal allowance was £12,500. The higher rate threshold was £37,500 and basic rate earnings was £50,000. 26-27, the pension is going to go up to £241.30. Personal allowance should be £16,795 and the higher rate threshold should be £50,383, which means in effect an individual should be able to take 67,177 and 6. This should say 26-27, sorry, against 50,270. So the impact of this is there's £17,000 more of earnings in the higher rate threshold than if the bands had stayed the same. Not just directors that are affected, it is salaried people. And I've done a range of £25,000 to £100,000. So at £50,000, the cost of the stealth tax is £8,444.85. So on in £60,000, the cost is £2,790.85. And 75,000 is £4,226.27. So this is the extra tax people are paying because they haven't increased the thresholds. And again, those that work with me know I like a good diagram. So looking at the £60,000 dividends and salary, the salary is £12,570, 47,430 of dividends. You're getting the top slice taxed at 35.75%. Whereas actually, if the bands had increased in line with inflation, your salary would have been 16,795 against 43,205, and you'd have still had some basic rate band available. Companies. Overdrawn director's loan account, there's what's known as a Section 455 charge. That's increasing in line with the dividend rate. HMRC see that if you've got an overdrawn director's loan account, you've had the money that it would have been paid through self-assessment as dividend tax. So you make a payment on account to HMRC until your director's loan account is repaid. When your director's loan is repaid, you make a claim to HMRC and they refund the Section 455 tax, because their theory is, not mine, their theory, that they'll have had that extra tax through self-assessment. Capital allowance is, there's a 1.1 million annual investment allowance. After that, you get a 40% first year allowance. The main writing down allowance has gone from 18 to 14%. And the first year allowance on electric vehicles has been extended to March 2027. These are for new vehicles only. Research and development. This has been a real hot topic for HMRC recently, where a company makes a scientific or technological advance. The system's been abused over the past few years. HMRC have clamped down. There is an advanced assurance pilot, which basically means if you think you've got an R&D claim, before you have to go to the expense of having a full report, you'll be able to get assurance from HMRC that it qualifies for the relief. Share reorganisation. So we have, for example, a construction company. They have a parent company that owns the trading company, an investment company for their buy-to-let property, and another company that buys and sells land. It's quite popular to put parent company in place, particularly if you're looking at selling an arm of the business, because there are things like significant shareholders exemption, which means you can sell part of your business tax-free. What HMRC have got is further anti-avoidance provisions, so that if you are putting a holding company place or changing a group structure with the purpose of avoiding tax, it will not be allowed through. They're also doubling the filing penalties for corporation tax returns from April 2026. So again, there's a big sort of theme with payment to HMRC in this budget. CIS, HMRC. So CIS is where a company is in the construction industry, it employs subcontractors, or it contracts to another company. There is an automatic, or they have the ability to put a 30% charge where a company has paid or received money where they should have known it was connected to fraud. What it can do is remove the gross payment status for 5 years. So if you think of a typical construction company that have got contractors working for them, they will pay their contractors weekly. They won't be able to invoice the construction company until a stage has been achieved on the contract. That could be a 90-day cycle. Then they could have to wait 90 days for their money. And when they get their money, they only receive 80% of it because they have put back on to net payment status. So the idea behind this is that actually they've got to comply, otherwise it will just cripple them cash-wise. Inheritance tax. This was announced last year, but just a reminder that pensions become part of the estate from April 2027. Business property relief and agriculture property relief is transferable between spouses from April 2026, which under the right circumstances means potentially £3 million can be left in the estate tax-free. You can pay HMRC in interest-free instalments over 10 years where the property is eligible for business property relief and agricultural property relief. Charity gifts being made as part of an estate. It must be a registered charity or a community amateur sports club. So there are lots of sports clubs locally, for example, grassroots teams that might not be registered as a formal community amateur sports club. So it's just making sure if you are making donations, it is to one of those two bodies. And just by way of an example, and this is some of the clients that we are working with, we've got a client with a business that's worth £2 million, main residence £500,000, pension fund £500,000, estate £3 million. Married couple can transfer the business property relief, the agricultural property relief, sorry. The income tax in 2024-25 would be nothing. From 27-28 it'd be £200,000. If you before you could transfer the band, it would have been £600,000. Again, on the right, you've got business value of 2 million, main residence 1 million, pension fund 1.2 million, buy-to-let property £600,000, estate value 4.8 million, business property relief 2 million. The IHT would have been 440,000 prior to the budget. It's now £920,000. So planning points for inheritance tax. Are your wills up to date? Are they relevant now? Gifting. Can you gift your wealth earlier? So, for example, if you're holding on to cash for children, you're not going to use it. You're just letting it sit there to pass as part of your estate. Would it be better to gift it early and then enjoy it? Personal balance sheet hasn't really been prevalent previously, but what is the value of your estate? Work out what is going to be taxable and what the potential IHT is. Succession planning with the business, historically family businesses would have been passed father to son, or mother to daughter even. But who is inheriting the business? You can no longer hold on to it and pass it down tax-free. So what is the route to getting the next generation into the business? Landlords. There's an additional 2% tax from April 2027. Incorporation relief. So there has been a recent case or a recent with the landlord, Ramsey. Incorporation relief is where you work 20 hours or more in a property partnership, and you can, under stringent circumstances, move your property portfolio into a limited company without paying stamp duty or capital gains tax. Incorporation relief was automatic previously. It now has to be disclosed on your tax return when you use it. So again, my understanding or my suspicion with this is you incorporate a property portfolio, you put it on your tax return, HMRC are going to look into it. Share reorganisation, I've mentioned about anti-avoidance measures before, but there are a lot of family investment companies, and again, they're clamping down on the moving, putting shareholdings in children's names. International property disclosure. So a bit like the banks do with overseas accounts and interest, they are looking at a scheme where landlords that have properties abroad are reported to HMRC to make sure that they are on their tax returns. There is no changes to capital gains tax. So again, it's looking at considering incorporation versus the IHT. So just looking at incorporation relief, you've got to transfer a trading property partnership. It's stamp duty exempt. Capital gains are rolled into the base cost of the shares, so you've got to have enough equity in the shares. It's subject to strict criteria. There is a tried and tested case. The 20 hours applies to both partners, so there needs to be at least 40 hours work if it's a husband and wife partnership. And where there's a corporate partner is a known tax avoidance scheme. Inheritance tax planning. Father and mother own properties. This is an actual client of ours that have got a portfolio value of 1.9 million. They want to leave the portfolio to their children. So do they leave it in their estate and pay the inheritance tax, or do they trigger a capital gain? Capital gains tax in this case was 261,000. Capital gains is obviously paid on the difference between the value of the property and what you paid for it, versus an inheritance tax of 773,000. The only issue with this is because this is a gift, there is a 7-year clock risk that you get double taxed. So again, part of this, what we're doing is we're talking to clients about the timing of it and doing it a lot earlier than maybe they thought they were going to. HMRC compliance. This is a big area of what was announced in the detail. HMRC are investing £59 million into transactional risking. And this is digital prompts for VAT and corporation tax. So they are investing in technology that will look at corporation tax returns and VAT returns, and if it doesn't look right, they will issue nudge letters. Nudge letters are where you are given the opportunity to correct returns before opening up an aspect inquiry into them. There is going to be mandatory VAT e-invoicing from April 2029. And they are looking at putting in mandatory PAYE and VAT payments by direct debit. There is a consultation in early 2026. There's increased late payment penalties on VAT and self-assessment. And they are looking at more timely payments for self-assessment. So where you've got pay-as-you-earn income, they will look at taking self-assessment income from through your tax code. They're having a consultation in early 2026 on how to address timely payment for people with no non-PAYE consultation, with non-PAYE income, sorry. There's also going to be a crypto reporting requirement for UK-based service providers. And I've mentioned about the international property disclosure. They are also introducing incentives to report significant tax evasion. And where you do, people will be incentivized to do that. And again, going back to the original slide about not being able to touch the main rates of tax, one thing that they can do is look to get the tax earlier or look to get people paying on time. So it's not surprising me that these measures are coming through. It's not just companies and individuals that are coming under more scrutiny. As tax agents, we are also having new measures. You might not know accountant is a protected name, and there are lots of unqualified and unregulated accountants that work on behalf of tax agents. We are regulated by the Institute of Chartered Accountants. We are qualified and regulated, but anyone that is dealing with an individual or a company's tax affairs will have mandatory HMRC registration from April 2026. Where an agent has facilitated non-compliance, HMRC are able to get file access for their workings, and there are tougher penalties for agents that facilitate non-compliance, a bit like the minimum wage and promoters of tax avoidance. Promoters of tax avoidance schemes will have a name. For us, it's a good thing because it means that it's a level playing field and that companies are offered the same level of advice. It also means that businesses and individuals aren't sort of left high and dry when they are using a non-regulated accountant. Digital by default. So this is where you have a HMRC online account. They are going to communicate with you via your online account, no longer by letter. It's going to happen automatically. You can opt out. It will be automatic where you use HMRC's digital services. And again, just a prompt, during COVID, did you create a self-assessment online account to claim some of the COVID supports? Because a lot of clients did. You will have an HMRC digital services account. HMRC could automatically be sending you letters and reminders to this account, which you haven't accessed for nearly 5 years. So just a bit of a prompt to sort of like get yourself registered online, opt out if you still want to keep letters, or just make sure you've got access to any correspondence from HMRC. Because HMRC's system isn't straightforward, it is a gradual rollout while they deal with one area at a time, and there's no set dates of when this is going to happen. Now, it isn't a budget for business and it isn't a budget for generating wealth, but deep in the depths of the legislation, there is an entrepreneur survey. Now, you look at the survey and you think it's about share schemes and incentives for investment. If you can get past the first page, there are some questions about what you think of the UK tax system. Part of the spiel that comes with the survey is they want Britain to be a great place to do business. Clients will have a link to this, but have you say, fill it in. The deadline's the 28th of February. But you know, where you are suffering from additional tax and why it's a burden, it might not get used by this government, but there will be a panel that will be reviewing the responses and making the recommendations to the Treasury. Any questions?
No, I don't think so.
Oh, thank you.
Okay. Oh. Thank you for attending, and any questions or anything you want to cover, just drop us an email at hello@spotlightaccounting.co.uk. Thank you.